Hugh Johnson joins us now, and he joins us on a day when everybody is worried about recession, and suddenly for a market which was, global markets which are just in a rip-roaring bull market, looks like there is a cause to get worried. Mr. Johnson, good morning. Greetings from India. Thank you for joining us. What has changed so suddenly that the markets are now worried about growth, crisis, yen carry trade, just about everything has come together?
Well, I think, there always has to be some, news of some sort that sort of touches off the correction. And I think, quite frankly, the market had been a good market for a long time, and it had reached levels were a little bit pricier overvalued, which made them very vulnerable to some bad news. And of course, we got that bad news when we got the very poor increase in non-farm payroll employment, very soft numbers when we saw those numbers on Friday. And very importantly, obviously, an increase in the unemployment rate, which was not expected. The increase to 4.3% was not expected. So what we had was a very sharp decline in stock prices, probably long overdue. And of course, a very big increase in bond prices and decline in interest rates. And when you look really carefully at the numbers, you see that the markets, both the stock market and the bond market together, seem to be pricing in or discounting three reductions in the federal funds rate or in interest rates by the U.S. Federal Reserve in the fourth quarter, September, November, and December. And they've almost precisely, right to the nickel, done that. So I think it's really telling you, number one, there's a risk of a recession. I think it's premature to say that, but nevertheless, there is a risk of a recession. And in response to that risk, the Federal Reserve will reduce interest rates 3 times in 2024. And let's not forget, there is the expectation that after reducing interest rates 3 times in 2024, the expectation is they'll reduce interest rates 4 times in 2025 or 1 time each quarter. So it's worries about a recession. They're somewhat well-founded, a little bit overdone, but nevertheless, an expectation of Federal Reserve reducing interest rates in response to those somewhat well-founded worries, maybe a little bit premature.
The US stock market has 2 large parts. One, the tech part, which is where you have the Nvidias, the Microsoft, and the Metas of the world, and then really is the real economy part, which is you got, construction, oil and gas, other sectors. Which end of the market, to your mind, given there is a recessionary fear, is more vulnerable to a sell-off?
Well, what we saw before this was, first of all, small capitalization stocks start to recover when we saw before this very sharp correction. The second thing we saw along with that, of course, was a decline in the relative performance of the technology, the big so-called Magnificent Seven, and then a broadening or a spreading out of the returns in the market. I think we're likely to see when this thing is over, when the correction is over, and I don't think it's going to last much longer or go much deeper. When it's over, I think you'll see a return of the kind of broadening out of the stock market. In other words, it'll be spread among a number of different sectors. The problem, of course, with technology is that as the expectations for the artificial intelligence and sort of a payoff, or to start to see that show up in the revenues of those that are really investing in artificial intelligence, would start to show up. And we really didn't see that when we looked at the numbers, particularly, for example, the numbers of Microsoft. I would warn everybody, yes, artificial intelligence is important, but it's going to be the progress towards the payoff. The productivity payoff is going to be linear, not exponential. It's going to take some time. And I think we're now suddenly learning that. And that's why there's been a movement or shift away from the so-called AI technology companies into a broader stock market. And I think that's what's going to survive this correction after we get finished with the correction. And hopefully, again, I cross my fingers and say, I hope it doesn't take too long.
So, Mr. Johnson, now let me speak on behalf of emerging markets, which is that historically when there is a recession in developed markets, it has always benefited emerging markets. Markets like India tend to get inflows rather than outflows when there is a recession in US or developed markets and when interest rates are peaking around. Do you think indirectly this means, do you think that money could start coming back to emerging markets?
It could, yeah, and that's the historical record. You're absolutely right. When you take a look at the record, that seems to be one of the things that results or occurs because of a stock market correction or correction in the US, particularly if it's associated with an economic contraction or a recession. But we've seen the relative performance of the US has outperformed for such a long period of time. I'd like to see the relative performance of the emerging markets start to do better before I make that shift or make that bet. Yeah, we could see it based on history. You're absolutely right. We could see that shift and it'll show up in relative performance, but it's been such a long time before seeing the emerging markets outperform or perform close to the S&P 500 that I'd wait and see it start to develop first.
Much, Mr. Johnson, for joining in and giving us your assessment of the kind of brutal sell-off that we're seeing play out across the globe and across all asset classes.
Nice to be with you.